Death by 1,000 pools. How liquidity fragmentation threatens DeFi. Securing sustainable liquidity will be essential for DeFi's future, says Jason Hall of Turtle Club. The maturation of DeFi technology has created a paradox. While battle-tested codebases and rising technical proficiency have lowered the barrier to entry for launching new protocols, securing sustainable liquidity has never been harder. As thousands of projects built on increasingly standardized infrastructure compete for a finite pool of capital, the ecosystem faces a systemic challenge that threatens genuine innovation and growth. You're reading Crypto Long and Short, our weekly newsletter featuring insights, news, and analysis for the professional investor. Sign up here to get it in your inbox every Wednesday. Liquidity in DeFi is fragmented across protocols, chains, and token pairs. For new protocols, securing adequate liquidity is existential. Without it, user adoption stalls, costs rise, yields fall, and the growth flywheel fails to accrete value. This creates a fundamental challenge. Every new DEX, lending platform or yield farm must compete for the same finite pool of capital, further dividing available liquidity. The demand for liquidity vastly outstrips the influx of new capital. The traditional finance concept of cost of capital has evolved into cost of liquidity in DeFi. But without standardized frameworks to price this risk, protocols struggle to acquire the capital they need to launch and grow effectively. Protocols use their native tokens, ecosystem funds, and sometimes their own capital to attract early liquidity. Some under-incentivize, failing to attract liquidity providers. Others over-incentivize, depleting treasuries and creating sell pressure when token incentives unlock. Both approaches ultimately undermine long-term sustainability. This mispricing creates a fundamental tension for projects with VC backing. Investors who fund portfolio companies via simple agreements for future tokens, SOFTs, want protocols to attract sufficient liquidity for growth and utility. However, aggressive liquidity incentive programs directly dilute their token holdings. The result is often unsustainable tokenomics. High initial emissions to bootstrap liquidity, creating artificial success metrics that collapse when incentives decrease. This pattern hampers genuine innovation, as truly novel approaches face disproportionately higher costs to attract capital. The problem is compounded by lack of transparency. Most significant liquidity arrangements occur through private over-the-counter, OTC, deals with unclear terms. New protocols have no visibility into market rates for comparable arrangements, while established players and insider networks control capital flow. Without standardized risk assessment frameworks, liquidity providers struggle to evaluate opportunities effectively. This leads to inconsistent risk premiums across similar protocols and capital concentration in projects with familiar designs rather than superior technology and innovation. What the ecosystem needs is connectivity between capital and protocols, a chain-agnostic, protocol-neutral layer focused on efficient capital routing. Such a system would. Establishing a system like this isn't about introducing new financial products, but creating a shared understanding of liquidity pricing that aligns incentives between capital allocators and protocols. As DeFi matures, standardizing liquidity coordination and risk assessment will be essential for capital efficiency. The protocols that thrive should be those that solve real problems and bring real innovation to the space, not necessarily those with the most aggressive incentives. The challenge is clear. Demand for liquidity in DeFi is effectively infinite and the finite supply is existentially important. Yet the infrastructure, services, and pricing mechanisms that determine how capital flows from holders to users have significantly lagged behind protocol innovation. Addressing this infrastructure gap represents not just an opportunity to increase efficiency, but a necessity for the sustainable growth of the entire DeFi ecosystem. Jason Hall is the CEO of Methodic Capital Management. As an Army veteran, Jason started his career in financial services as a self-directed equity derivatives trader before moving to a frontier markets-focused hedge fund as an execution trader. From there, he joined the global macro hedge fund Bridgewater Associates, where he helped build several investment teams before transitioning into the front office, where he helped manage the firm's multi-asset beta and benchmark exposure. Jason has a BA in economics from the University of Connecticut.